spirit. We must be a team.
Business is war. It's dog eat dog, rat eat rat.
You gotta have a problem that you want to solve.
Hi, I'm William Bryant, and today I'm going to talk a little bit about contribution margin. This is a favorite subject of mine because I like it for cost analytics and cost management. But also, you'll notice when I talk a lot about data, if you have a lot of data, and of course there is tons of data available, you have to have methodologies set up on how you want to set up the data and utilize it for analysis. And yeah, absolutely, you have standard financial ratios and so on and so forth. But when you go granular into operations, I think you'll find an awful lot of times an analyst is trying to figure out, well, what and how do I analyze? Contribution margin sets that up for you. And it also, it lends itself to better profitability analysis, break-evens, cost volume profit. And you also get op leverage and finance leverage out of that, just because of the way you have to set up your costs. And so I think it ends up being a good structure, especially for internal reporting. External reporting being different because GAAP compliant reporting is not contribution margin, it is gross margin, which most folks should be familiar with. But that being said, I'm going to talk a little bit about contribution margin and what it is. So, contribution margin is revenues minus variable costs. And so it gets a little bit confusing because a lot of people assume that their cost of goods sold, the COGS account, is a variable cost. And while some companies do that as a variable cost and don't necessarily put into the allocated overhead to the unit sold, or take into consideration all of the other stuff for that are required for sales, and that includes the actual housing of it, because you can't sell it if you're not putting it somewhere, and so all of those things go in. And overhead also includes security, insurance, all of that kind of stuff that goes into selling a product. But that being the case for GAAP accounting, that's what's called full absorption or full costing of a product. And so you have the variable costs, like for example direct material and direct labor. Those two portions go into the actual activity of creating a product. If you think about manufacturing, merchandising, service-based accounting examples for business setups. And in the manufacturing setting, you then have an allocated overhead that is going to be assigned to that product by the total number of units that are anticipated to be created. I won't go too in depth of it because you can have over under applied and those kinds of things. But the point is that in a full absorption, when you're doing gross margin, you have a little bit of fixed that's allocated, and you've got the costs that you can directly trace to producing or making that product. And that's a full costing. What happens when you do a contribution margin is you take all of the costs that are variable, and it doesn't matter if they're OPEX, like for example your SG&A, right? Your sales, because you might have commission based. That would also be a variable cost associated with the revenues. And so you take any costs that are variable and you move all of those, right below the revenue, if you think about your income statement, right? So you have your revenue minus those variable costs, and this is where it kind of gets, because you're thinking, oh, well, some costs might be semi-variable. And of course that is true. And so it does take a little bit of art on how you do this, but nonetheless, the idea is to move all those variables up top. You subtract the variables that are directly associated with the ups and downs of whatever your revenue sales are. That would give you your contribution margin. Everything else is fixed. And so once you deduct all the fixed, you still get back to your net income just like you normally would. You just rearrange it on the income statement in a contribution margin fashion, so that you can see, hey, which costs are variable, which ones are fixed. Now, this gives you the benefit of being able to look and say, we're going to budget out for a specific price on labor. We're going to budget out for a specific price on materials. And then we're going to look at actuals, and we're going to figure out, what really occurred. And it sets up a variance analysis for you, so you can get in there granularly and say, oh, wow, well, during this time period, it was actually the cost of materials that changed. We went through many more, cubic meters or whatever of materials. And that really raised our costs. It wasn't the price that changed, it was that. And then all of a sudden you go and you look, oh, the supplier was giving us cheaper materials. You get questions at that granular, or you get questions answered at that granular level, because in cost analysis, it doesn't necessarily do you any good to be at a high level. You have to figure out what the source, the cause, the root cause of the problem is, and then get and attack that. And if you consider the fact that you keep rolling and aggregating up entries into your ledgers before you actually do the presentation, well, the more detail you roll up, the more smoothed out any serious variations in data can become. Now, what I mean by that is, let's say we look at just direct material, direct labor, okay? And we're just going to look at them from cost perspective. We're going to say the labor is, $100, $100, $100. Okay, no big deal, it's flat. So the variance is all in materials, and say it's 20, 50, and 30, okay? Now, if you add those together, 120, 150, 130. If you take them and say we run an average on that, and that's, it's like 130, right? Well, if we're really just kind of like figuring out what's our long run average on this and what's our variance from that, well, 120 and 150, it's 10, and then it's 20 from 130, right? I mean, the percentage-wise is like 9% and 18% or something like that. I know, just stick with me for a second. If you go all the way into the material and actually look at 20, 50, 30, and you say, oh, wow, because again, it's around 30, right, is our average. Well, the difference or the variance from, the 20 to the 30 is $10. Well, that's nearly 30%. It's a significantly larger percentage. And that's because of the fact that as you stack more things on top of each other, aggregate more numbers, you actually get this smoothing effect. So you lose those peaks and those dramatic changes that are helpful in identifying where your costs have changed dramatically. And so that's really where you have to get granular on these things. And by setting up your data in such a way that you can get into these variable costs and then set them up so when you're doing the reporting, I mean, you can obviously change that and do it for income statement or a gross margin statement as well for standard external reporting. But by setting it up that way, so you have these internal reporting and external reporting, you get better analysis. And so you can make use of it while still keeping all of your reporting and those kinds of processes for external stakeholders and so on, because obviously that's a necessity, but those just aren't as useful for an internal analysis. And your baseline on your contribution margin, because you're looking at variable costs, will really alert you to what has changed in our activity when we were delivering our product or service. And then of course you get that other piece, all your fixed charge. And one of the benefits of doing that, like I said, obviously you look at financing and you get that leverage. And so you get that analysis there, like, how much of this is being financed from debt. But you get even further with that and you can say capacity planning. What are we paying out capacity-wise for assets, and what is our utilization on those assets? are we underutilizing? Are we pushing that almost over, utilizing, where we've got to do that step up and purchase that next, that next level of machines so we can do more output? What is actually occurring in those fixed costs relative to our overall production? And by separating those out, you can actually do that centered view on just that aspect of your cost structure. And so, of course, we can go further into the other benefits of it on a profitability standpoint. I believe I did an example. It's probably on my website, but you can look at different segments where if you were using an income statement, you might look and say, hey, this segment looks unprofitable. Maybe we should do away with it, or a product line. But by looking at it from a contribution margin perspective, you find out that it's the absorption of those overhead costs that is actually making it kind of look that way. And that's why in the beginning I took the time to kind of try to explain full costing and the assignment of overhead, because that can impact how you view something and how you view profitability from just a gross margin to your net income versus a contribution margin perspective. And that becomes also important, because you don't want to throw something out that is actually saving your bottom line, which does happen to be the case sometimes, and you just misread it because you thought the financials were telling you something that they weren't. And that's a pretty common thing. I mean, let's face it, you get into the accounting methods and they get pretty complex, and especially when you're trying to keep track of, non-cash and cash and, all of these other things that go into it, right? So that is just a brief talk about what I prefer. And I mean, yes, I presented it as manufacturing, but if you think about it, whether you do service or retail, it's the exact same thing. You still can present it from a variable cost and fixed cost perspective, because you do have those elements within your cost structure on retail and service-based industries. It just might be a little bit different to kind of pluck out, as if opposed to direct materials. You're going to have other things that are involved. Like, I mean, they still could be materials, just not in the same way. For example, service-based industry using a lot of PPE. Okay, hospitals, veterinary, all kinds of cleanups. You still have materials. They just happen to be a little bit different than what you would think of when you're making, a consumer packaged good product. But they also have to be assigned and accounted for costs to provide a specific service. Think about, all the gowns that are worn, in a hospital, and then they all have to be cleaned. All of those are variable costs that all get tacked into a specific service that you're providing. And of course, they all vary directly with the service, so they're that variable cost. I mean, talking about from that, we could even get deeper into this as opposed to standard costs and actually get into activity-based costing, which is, another level, but also nicely related to contribution margin and generally provides even more accuracy in your cost estimation. But obviously, you can tell I'm kind of a fan of the cost margin or contribution margin for, its benefit for not only the profitability side, but the way it can set up how you actually are able to analyze your costs. I mean, that's a big one. So, thank you.